Welcome to episode number 38 of Colorado TechCast. Hey everybody, Trapper here. Thanks for joining me on this episode of Colorado TechCast. Colorado TechCast is a weekly podcast where I interview CEOs and founders of Colorado-based technology startups. Join me each episode as we explore the Colorado technology community from the inside out. Colorado is one of the most innovative states in America. We have one of the highest concentrations of entrepreneurs and tech companies in the nation. But in order to keep growing, these companies need capital. Capital is the lifeblood of early-stage businesses. However, according to Pitchbook, we're not even in the top 10 when it comes to receiving venture capital funding, although we've got a multitude of investment opportunities in early-stage companies. The team at SmartCapital is here to change that. From an investor's perspective, early-stage companies can be one of the highest returning asset classes out there, but historically, the opportunity to invest in high-growth companies has been reserved for venture capital funds or wealthy angels. Early investors in Facebook, Uber, and Snapchat made millions of dollars based on their relatively low initial investments. Early-stage investing is risky, though. Many investors believe that the best strategy is to invest in around 25 companies to ensure diversification. They know that a small number of those companies won't make it. A few will not really make it big, but of those 25 companies, hopefully, one will hit big and return 10x the investment. That's the goal. The founders of SmartCapital Colorado want to enable more people to invest and share in the rewards. With SmartCapital, now you have investment access to some of the fastest growing companies in our state. They've built a portfolio of 25 fast growth companies with some pretty clever criteria. To be included in the portfolio, the company must have strong ties to Colorado, have revenue and trajectory to grow revenue with additional funding, have an identifiable market size that the company can expand into, and best, every startup in the SmartCapital Colorado portfolio has already been backed by other reputable VCs or accelerators. Accredited investors can start for as little as $30,000, which is approximately $1,200 per company, and you're immediately diversified amongst a variety of promising fast growth companies in our state. You really won't find access like this anywhere else out there.
Paul Foley is a Colorado native and huge tech startup enthusiast. He co-founded and sold a tech startup called Augur to BounceX, and has since turned his attention to investing in venture capital. He has created a new investment model, SmartCapital Colorado, which is a portfolio of 25 fast-growth Colorado companies.
Paul, thanks for being on the show today.
Thanks for having me.
How did you get your start in venture? Tell me your startup story.
So I would call it start an angel. So we had a tech company called Augur. We ended up selling that or merging that with a larger company out of New York. And then I went around and I started doing angel investing into a few companies, one here and then one in San Francisco. And then also started joining angel groups and wanting to get more active there. While doing that, I also was really interested in bringing more venture capital to Colorado. So one of the things that Colorado has a great density of entrepreneurs. There's tons of talent here. But from a standpoint of compared to New York or compared to the Valley, it's one of those, it's an area that's underfunded comparatively. And so I think there's a lot of talent here that deserves funding and has great opportunities that is getting kind of passed over. So as a native, I was actually really interested in how do we get more funding into the state. And so I was kind of focused on doing some angel investing, getting more venture here, and then worked with Boulder Bitch, which is a startup studio, on a project idea to kind of use the internet crowdfunding to get more venture capital in the state.
Do you know the stats on VC money in Silicon Valley, New York, Colorado?
So these are rough estimates, but from Pitchbook, so Northern California gets around 60% of all venture capital.
60%?
60%.
Wow.
So that's between San Francisco and kind of the San Jose area, like everything in between. It gets around 60%. A lot of those are growth rounds, so a lot of those are like the $1 billion or the $500 million or the $200 million rounds.
Just following on big companies getting bigger?
Yep, big companies getting bigger, unicorns. And then New York gets 16%, and then Boston gets 10%. Denver and Boulder aren't even on the top 10 list, surprisingly.
Really?
They get less than, so Miami is number 10, and I think they have like 1.3% of funding, and so Denver and Boulder has less than that. And again, I think Colorado has a pretty good seed funding area. So there's a lot of angels here. There's a lot of accelerators, and there's like a large angel group, RVC, obviously. But I think one of the things that Colorado lacks, or at least what you'll see from the companies, is kind of the bigger rounds. So anything I would call over like 1.5 million plus. It just seems to be a lot of those rounds are from the coast. So whether it's a large seed Series A, definitely Series B, Series C, most of those rounds are raised from institutions on the coast.
So is it just lack of capital in the state? Because we've got quite a few venture capitalist firms.
So kind of. So Foundry is one of the best VCs probably in the country, and they're based in Boulder. But if you look at them, they have a $400 million fund. They're about to, I think they just announced they're going to do a $750 million fund. And then you have Techstars as a $400 million fund that does follow-on funding into Techstars companies. Other than that, you have kind of Access Ventures, which is around 50 to 70 million. And then there's a lot of micro VC. So there's a lot of $10 million, $20 million funds. But when you look at the density, so having two basically $400 million funds in Boulder, both of which don't focus. So Foundry even put out statistics. They do less than 25% of their deals. They shoot for 33%, but they do less than 25% of their deals in Colorado. And then Techstars is a follow-on fund for the global organization. So they're not necessarily focused on any specific geography, not Colorado or anywhere else. They just follow on to the better Techstars companies. So you don't really have a geographic focused fund that's larger, and you also don't have that many. So there's two big VCs here, or two larger VC funds, but other than that, you don't really have a major fund. Whereas you go down Sand Hill Road, there's 20, 30 of those Foundry Techstars funds literally in that street. So it's kind of like when you look at the disparity of that, it's much bigger, obviously, in the valley.
Prior to starting Smart Capital, tell me about your experience.
Sure. So I went to University of Michigan as industrial and operations engineer. I wanted to be, it was either going to be an iBanker or financial engineering was kind of the thought. I ended up getting kind of caught by the entrepreneurial startup bug. So there was, this was 2007 to 2011 I was there, and that was kind of the emergence of things like Facebook and all the other Snapchat started in college when I was there, and so it was just kind of like, not that I actually knew of Snapchat at the time, but there's just a bunch of entrepreneurs that were starting. Dropbox, it was kind of like this wave of younger entrepreneurs that were coming out that weren't waiting until they were older to start their companies. It was these young tech kids that were doing really cool stuff. So I think most kids in college that were kind of more ambitious were seeing that, and it was kind of interesting to see this idea that you could build your own company relatively soon. And so I think that, and also the financial market crashed. So when I was looking at working for a bank or working for one of the larger iBanks, it was kind of like, is this really a good career to go into, looking at why the economy crashed? And so I ended up being a tech consultant at Deloitte, which I was only there pretty briefly before actually joining a tech startup. And then I joined Belly, which was a fast-growing startup out of Chicago, and then moved from that to actually consulting for fast-growth companies in Boulder, Denver, and kind of that area. So it was SolidFire, which at the time was a 20-person company. I set up NetSuite and Salesforce for them, and then they scaled on, and then Full Contact, Ventus Solutions. There's quite a few that were kind of these fast growth companies. And it was really cool because I was pretty young. I got to get paid as a consultant, and then you also get to see kind of like the internal workings of these really cool, really fast growing companies. I learned a lot from that. Mm-hmm. I met my two co-founders just through general networking because I would go to a lot of startup events to try and get obviously clients, meet future clients. And I ended up meeting two founders that were really technical, that were building a cool product in Augur. And I remember we would go to breakfast and we would talk about all these things, and we ended up focusing on it as an ad tech company, and there was a lot of potential there. We were getting a lot of interest from these ad tech agencies, DSPs, and so I ended up joining as like a third co-founder. And then then from there it was kind of, we took off, we merged with BounceX, and now here.
So what's the story of the merger of Augur and BounceX? Like, what was the driving force there?
It's kind of boring. It was more, we brought on a new CEO who had a lot of experience in ad tech. He had sold 3 ad tech companies prior. He had a pretty big vision for the company, but we had acquisition offers pretty much in the first months that he joined. So he ended up taking them. I personally thought it probably could be bigger, but and even the merged product now is doing really well. So, but he was able to sell it and merged into BounceX out of New York.
By this point in time, you'd run a startup.
Yep.
You had consulted a number of startups.
Yep.
Really liked the energy there?
Yeah, it was fun. It's people creating. It's going from like an idea to initial kind of product. It's also one of the things that I think I like. How do I say this? One of the things I didn't like coming out of college, which made me not go into iBanking or just quantitative finance in general, was I felt like in larger public markets or just when things get bigger, it's a lot of basically taking advantage of arbitrage opportunities or taking advantage of price differentiators. So finding good deals and that were undervalued and then obviously selling when it was overvalued. It's kind of like the model. Mm-hmm. What I really liked about entrepreneurship is it starts as nothing and then it goes into something that if it's successful is people are paying for and it's providing value. So it's in the creation phase of a life cycle. And so that's a very different energy. And it's very cool. It's to go from literally doesn't exist and then 2 years later it's now people are using it and adding some kind of value to their lives.
Thing at this point in time.
Yeah, it's you've gone from nothing to something and that's cool. And while it's fun at like a high level to do the kind of what mergers and acquisitions and all that, it just seems like it's much more of a overselling game as opposed to creation game.
Okay. So how did that lead into funding SmartCapital?
Yeah, so we raised from a firm out of Montreal, New York, and then we also raised from angels in Toronto. It was interesting because being from here, obviously would love to have Colorado funding. We didn't necessarily get there's just not that many options. And so that was we didn't get funding from here. And it was interesting because it was kind of like, I thought we had a very valid idea, obviously. And there was other investors across the country that thought we had a very valid idea. It was kind of frustrating seeing friends in New York and seeing friends in the Valley being able to raise at like a drop of the hat with pretty non-fleshed out ideas. And then seeing myself and other friends here having a lot of talent, a lot of really good ideas, not get that same level of access. So after Augur, I wanted to bring more venture capital here. So I got kind of interested in obviously angel investing, but then also how fund structures work. And then that led to SmartCapital. So SmartCapital actually started as a platform to help funds raise. So whether it was an impact fund, whether it was a fintech fund, the idea was that you could come on the platform, and then we were even actually trying to go for non-accredited investors to be able to invest into funds. And the idea was to use kind of internet marketing or just general kind of, it's called general solicitation, but the regulatory framework, but basically is to solicit through the internet to raise funds. And so we played around with portfolio funds, we played around with funds, models, I should say, and then we were actually trying to get regulatory approval for this non-accredited model for pretty much all of 2018. And so the idea was stop rambling. That was kind of like how it started. We ended up not getting the regulatory approval to get non-accrediteds involved, which we were hoping. There's a lot of reasons why if you're non-accredited and you can write smaller checks into kind of a portfolio or a fund structure, there's a lot of benefits to that. But right now it's not, you can't, just the way the Jobs Act is written. Mm-hmm. And so it's kind of frustrating because I think a lot of non-accredited and even angels that want more access, getting access to those deals, the better deals, is hard because usually what happens is the best deals go to VCs if they do get VC funding, or they go to angel groups. And then if you want to participate, they're not going to put themselves onto a crowdfund platform, and they're not going to obviously showcase that there's available opportunity. So you're kind of at a disadvantage. You're seeing a lot of the deals that kind of get passed over. And also, I would say a lot of non-accredited investors don't really know how to vet and understand good deals, because a lot of times it comes down to the founders.
So back up and explain, you mentioned accredited investors and non-accredited investors. Explain that.
Sure. So accredited investor is someone, there's two ways to become accredited. You either have over 200K, make over 200K a year in income, or you have over $1 million of net worth. So the way the Securities Act is written, it basically just says if you are a accredited investor, you can go and invest in private deals. You're pretty much unrestricted in what you invest in. If you're not accredited, so you have less than that $200,000 worth of income or $1 million in net worth, you're restricted on what you can invest into. The reason behind that is actually it's a good, in theory, it's one of those things that wanted to protect in situations like the Great Depression and for non-accredited investors to be not swindled, obviously. The problem, though, is it basically creates the rich get richer structure,
right,
where if you're non-accredited, a lot of times you can't get in some of the cooler or better deals.
The 10X rounds, the 10X companies.
Exactly. And so it was really kind of like hindering. And so I think there's a lot of ways that can be improved, whether it's like an accreditation test or whether it's actually putting money into a fund or with a fund manager that is a little bit more savvy. I think you see a lot of managed money in public markets, but the fact that you as a non-accredited investor don't even have the option to put money into kind of a managed type fund at this level doesn't seem to make any sense. And then the way I get how they tried to write the Jobs Act and the crowdfunding, which was non-accredited investors can now invest into these startups that go through this Form 1A and this accreditation or this process to do their offering. The problems with that is most of the really good companies that you want to be in aren't going to do that. And then two, as a non-accredited investor, like a lot of times still the best way to do this is through referrals or through your own diligence where you meet the founders, and the crowdfunding platforms don't really lend that to you. You're not able to sit down with the founders, look them in the eye, ask them questions,
right?
Which I think is a lot of what investing is. So
if you're going to put a lot of money into a company, you want to...
Yeah, exactly. And if you're not accredited, like it could be a $5K or $10K check. But yeah, it's like just looking at a video on a platform isn't probably enough to make a good decision, right?
Seal the deal, yeah. So can you be an angel investor and not be an accredited investor?
So you are allowed to invest in kind of like families or like really close friends, but you wouldn't be able to go to like a pitch event. So like, for example, when Techstars or RBC host their kind of like events, for accredited investors, like you wouldn't be able to just join in and sign a form saying you're accredited and then get pitched. Like that's not, you wouldn't, basically you can invest in anything that's like just in your immediate network. But you can't obviously go out and search for opportunities.
And that was the general solicitation?
Yep.
We're talking about. So did the Jobs Act introduce that, or what did the Jobs Act
So the Jobs Act tried to get non-accredited investors involved into these deals, and then it also kind of outlined what general solicitation means, which basically just says a company that's raising. So before, basically what general solicitation was prohibiting against is for a company to go out and just blast everybody that they didn't know, asking for funding. It put it into a way of, here's how, if you want to go and do that and you want to market your product, here's what you would have to do that. And so it kind of gave guidelines to a company that says, hey, we want to go and we want to talk to a bunch of angel investors or non-accredited investors. It said, here's the laws and regulations around how to do that. So for Reg D, which is what we're doing for SmartCapital, so we can do general solicitation where we can go and we can have articles written about us, we can blast it on LinkedIn, Facebook, etc. But we have to affirm that every investor that invests into the fund is accredited, as well as we have to do AML, so we have to know that they're not like a Russian mafia person like laundering money. And then there's certain things we can and can't say. And so it basically says, like, if you are going to do a general solicitation, which basically just means you're going to be pitching people you don't know, there's certain things you have to do to do that, and steps you have to take.
Okay. Yeah, that makes sense. SmartCapital is a collection of funds, or right now it's just one fund, but in the future, or potentially it could be a collection of funds?
Yep. So in the future, the idea is to keep doing funds that our angel network's interested in. And that we also think are good opportunities. The first one starts with SmartCapital Colorado. It's a portfolio of 25 fast growth companies here in the state. They all have a partner that we trust that is leading the round. We're following on each round.
Is that a venture capital partner, or?
In most cases, yes. So it can be anything from like Access Ventures to Newark Ventures out of New York. It could be, and then there's angel groups. So RVC, which I mentioned earlier, is an angel group here.
That's Rocky's Venture Club?
Yep. They actively go and they source deals. They do diligence on the deals. Then they put together terms for other angels to invest in. And it's even micro VCs or kind of these industry expert investors that don't necessarily consider themselves venture capitalists, but they'll put in money into certain industries or areas where they have a lot of expertise.
So how did you select these 25 companies for the first fund?
Yeah, so a big thing for us was sourcing from partners, again, VC partners, that we trust, that we wanted to get in the same deals on. So we started with sourcing, kind of building out a list of all the companies that were raising capital around here, whether from local or from kind of the coast. And so we source any company that has gone through an accelerator, any company that's got angel funding, or any company, or I should say angel group funding, or any company that has a more professional round. There's around 250 companies in Colorado that match that. We then dwindled that down to the 25 companies we wanted to invest in. And what we looked at specifically was companies that had the revenue growth that we wanted. So while VCs will invest for very different reasons, some VCs will invest in really cool or really interesting tech products that might be getting a pilot, might need more R&D, but once they're built, they're going to be really valuable. Some invest in certain industries, verticals. What we looked for was, does the company have the product? Does they have the initial revenue? And then can they scale the revenue? So if we give them, if the money that we're giving them plus what our VC partner is giving them, is it going to be used primarily for growth? And if the answer for that was yes, and they're going to be able to use that to grow pretty quickly, then that's how we determined which companies we wanted to invest in.
So if there's 25 now and there's plans for future funds, do you plan on segmenting those companies into different types or industries, or?
Yeah, so we would potentially do another Colorado fund. We'd probably have to wait a little bit to have the batch.
Find enough qualified companies.
Qualified companies, exactly. And so then they would be industry, vertical, or other geographies. So then it would just limiting it to Colorado every fund. While that's awesome for companies in Colorado, I don't think that's the best way to do it. I think what would be better is finding verticals that we can partner with other VCs on that we have a lot of interest in, that us and our angel network has interest in. That would be probably the better solution.
So it's kind of a two-part question, but tell me about your ideal investor, and then tell me about the process for going through, investing in and then exiting with hopefully more money than you put into it.
Right.
Although I don't know if you can say that on it.
Well, so right now, kind of the investor we service as a client is going to be an angel investor that wants to invest in companies, obviously in Colorado, that's looking for a return. So we are doing this with the intent of making returns. And so the angels that usually invest in early stage startups do it for various reasons. What we want is company or investors that are excited about Colorado, that are also understand that one of the best phases for a startup is when they have the product and when they're looking to scale. And so usually a lot of angels feel a lot more comfortable when the money is going to be used for growth. And then we kind of had this basket. So there's real estate tech companies, there's enterprise SaaS companies, there's hemp companies, there's consumer good companies, there's marketplaces. It kind of spans the different verticals. So it gives a investor access to multiple industry verticals. It gives them access to some of the better deals in Colorado. And then it also has their money going towards companies that are growing and growing quick. Yeah.
Okay.
And so angels, what we found is most angels want to end up doing something like 3 to 5 deals a year. It's usually just through a friend who they met randomly. It's usually they don't really they want to get in more deals or do more deals, but to do that it's a lot of work. You have to go, you have to source them, you have to follow up, you have to do the diligence yourself, legal fees. So what we find is a lot of angels want to do more deals, but the effort, whether it's because they're retired or whether it's because they're running their own companies, is a lot.
So how does an exit, or how does the liquidity event impact a fund?
Sure. So every fund's different. The way our fund's structured is when a company exits, whether it's an IPO or an acquisition, we do distributions at that time. So let's say a company, we put in $100K into the company and we get paid out $500K or $1 million from that company's exit. That gets sent to the investors based on the amount of ownership they have in the fund. So it's for us, it's as the distributions or as the event happens, the distributions happen.
Your percentage of whatever you invested in this company, and a relative percentage of that would be returned to the investor? Or?
Yeah, so we target 3 to 5% in every company that we're investing in. So let's say for whatever reason the company, we don't get diluted and we still have the 5% just for round numbers. Let's say we own 5% of the company. The company then 10Xs. So let's say it was, again, round numbers. So let's say we own 5% of a $10 million company. The $10 million, 5Xs to $50 million. We own 5%. We own 5% of that, and so that would be 2.5, right? And then we would take that money, we would send it to our investors when the distribution happens and when we get it.
Right. Okay.
But what normally happens, just to kind of give the whole process, is like we'll use the $10 million valuation, and let's say we own the 5% again. What ends up happening usually is the $10 million company raises another round, and we get diluted from 5%, let's say by 20%, so now we have 4% of the company. Did I do my math right? Yeah, I think so. 4% of the company, and now the company exits for $100 million. Now we have a distribution event of $4 million. So we get diluted as the company grows, but usually a dilution isn't bad because the company's valuation is higher. So even though we're getting a less percent, we still have a total that's bigger.
So the pie gets bigger, your slice gets smaller though.
Yes, exactly. Nice. But it's still bigger. The slice is usually still, or the intent is the slice is going to be bigger than it was before, even though the pie is much bigger, our slice is smaller, but the slice is still bigger than the previous
Worth
slice.
more.
Yeah.
Yeah, okay. I like food analogies. So Paul, talk to me a little bit about the future of crowdfunding. Like, where do you think it's going?
I think VC in general has been a industry where it's based on who you know. So the way a normal VC fund is structured is you go out to your network of whether it's angels or institutional investors, you raise funding for your own fund, and then you go and you deploy capital into the companies over a span of 3 years. I think it's somewhat, if you look at the operations or how it's structured, I think it's ineffective. I would say one of the biggest things that can be done there is a faster raise of capital and deployment of capital in just VC in general. And then also what we find is, I think it's 96% is the statistic that I heard from a Chloe Capital event, but 96% of investors are male, which means that there's a reason why it seems like a lot of other, the stereotype, right, is the 6-foot white male is the VC, and then
blue eyes.
Then they invest in the 6-foot white entrepreneur,
right, which definitely builds diversity within a company.
Right. So it's definitely one of those things where it's because the way the money's been raised and how it trickles down is based on proximity and who you know, and that's also one of the reasons why the Valley has so much of the venture capital. So when I look at crowdfunding, I just look at the internet in general, and I just look at operations, and I think one of the things that the internet does a good job of is it kind of equalizes things. So do I think it's a perfect answer the way crowdfunding is structured right now? Not at all, but I am kind of hopeful, or what I do think will happen is the way money is raised as the way money is deployed will change significantly. So whether it's better companies start actually using crowdfunding in the future, and whether it's more type of funds actually use crowdfunding, the theory or the hypothesis is as we continue to go, the internet will be used more to kind of collect capital and deploy capital. And whether that's one of the kind of big experience behind Ethereum that we saw with the DAO, which was like one of the largest collections of money, or Ether at the time, into like a pool to then be dispersed. I think we're seeing hints of this with crowdfunding, which is platforms like Kickstarter, equity crowdfunds, blockchain, ICOs, all of that. Like, it's a very imperfect system, so by no means am I recommending what's currently there, but I do think over time we're going to see funds, we're going to see companies, we're going to see innovative ways of actually raising and deploying capital through the internet. And I think right now, the way the current structure is, I think it's one of those things that's prime for kind of some disruption.
Okay. So, that'll obviously change like the big endowment funds, right?
So maybe. So the what I'm also kind of hopeful for is we've had this kind of aggregation. The general public usually has their money tied up in something. So whether it's an IRA or whether it's a mutual fund or whatever it is, it's usually like pension plans. It's kind of people give their money to other people to go and invest, which is fine if they're specialized and they're actively going to be investing it correctly. But I think too many times people just give their money to random.
Check the box on their 401k.
Exactly. And I think we're also going to see a lot more just financial education. I know it seems kind of like the hope, or has been the hope since the beginning of the 90s or the 1900s,
right?
But like since the Great Depression. But basically, I do think that a lot more people are able to learn about how money works, able to invest themselves, able to learn everything from now non-accredited investors have access to early stage companies. Like they can start learning about the life cycle of a company from the beginning. Now that you're seeing actually less companies go public, I think the kind of general market is kind of looking at public companies. Like Uber, for example, is going public at, they haven't announced their valuation, billions of dollars. Before, they would have to go public at kind of a $300, $400 million range to get the funding they needed to continue to grow. And then even kind of like the merge product right now with BounceX, like they don't really have many plans, at least from what I've been told, they don't really have many plans to go public anytime soon. They like being private. Elon Musk, if he had to do it again, would probably want to have stayed private as long as possible, just because he can't tweet whatever he wants to now. So I think this kind of like shift away from companies going public has made it interesting. It's kind of like public markets aren't as probably good investments anymore as they used to be. A lot of the actions happening in private markets. And I definitely think there has to be, and then this whole idea that non-accredited investors shouldn't have access or be able to invest in some of these better deals, I also think is kind of ludicrous. So what I'm kind of hopeful for is that people are enabled, whether they choose to or not, enabled to actually start investing in kind of more private deals, as well as make the playing field a little bit more even, and then kind of taking charge of their money, and then understanding how it's going to work. Yeah.
What does the tech outlook in Colorado look like?
So I would say this: Colorado startup scene has grown tremendously over the last probably 10 years. I think Colorado's been entrepreneurial. I think when you move to Denver or one of kind of this middle of the country, things aren't as established. Like you move to New York, and a lot of that stuff has been around forever, and there's kind of been the bigger players. I think Colorado's interesting because it's a very entrepreneurial attitude. Like there's not a lot of pre-existing things here, so it's kind of like you show up and then you kind of like you build your own brewery, or you start your own like trucking company, or my dad was an entrepreneur. He started his own paper printing business. It's kind of like you show up and sometimes like things aren't as established, so you have this spirit of like, I'm going to go build it myself. And then I think also like a lot of entrepreneurs are travelers to begin with, and so if you look at LinkedIn Workforce Report, they showed that people are moving the net. It's not the most moved to place, just in terms of numbers, but in terms of net gain, Denver is actually the second most moved to place in the country.
Really? What's the first?
Austin, Texas. So I
would have bet on that, either that or Seattle.
Yeah, I think Seattle's probably like third or fourth. What you see though, and they show it visually, but the San Francisco, New York, and Chicago are having a ton of the amount of net gain coming to Denver from those places is huge, and I don't think you had that before. I think Colorado probably had a loss to those places forever, and then you just didn't have the same level of people moving here, and so I think you have a lot, like usually people that move away from home or you move away from their existing situations are pretty entrepreneurial. So I think you have a lot of really talented people moving here, starting companies here, and I think we're kind of like primed for being like one of the major tech hubs.
I'd like to see that. Yeah. So the tagline, entrepreneurial by nature,
right?
We have on our websites and stuff like that, kind of speaks to that.
Right.
That get it done attitude.
Exactly.
All right, so Paul, thanks for joining me on Colorado TechCast today. If people are interested in finding more information about SmartCapital, where can they go?
Colorado.capital.
Colorado.capital.
Yep, made it super easy. So Colorado.capital, if you're a accredited investor, you can actually click the Learn More sign-in button, and you can actually view all the 25 companies we're investing in, as well as more information about the offering. And then if you have any questions, you can email me at paul@smartcapitalx.com.
Okay, great. So we'll get links to all of those in the show notes. Paul, thanks for joining me on the show. You guys are doing some really cool stuff.
Oh, thank you.
I think just getting an infusion of cash in Colorado companies will bring a lot of good things to the state. So look forward to following you and see what the next chapter brings.
Awesome. Thank you.
Thanks for listening to this episode of Colorado TechCast. Visit our website at coloradotechcast.com for episode show notes with links to all the great resources we've talked about in this episode. While you're there, click the subscribe button in iTunes so you'll never miss a new episode. I'm Trapper Little, and I'll talk to you again on the next episode of Colorado TechCast.